Assalamualaikum and a very good day to all viewers out there. I'm Yusna Liza Hamid. Today we are going to discuss the statement of cash flows under the Mfrs 107, which is equivalent to IAS 7. Our discussion today will not be doing the preparation of statement of cash flow, rather it will focus on the requirements of Mfrs 107 or IAS 7 pertaining to what a cash flow is, as well as what are the rationale and components or the presentation of cash flows. So let's start. We always hear this, cash is king. So every business entity, whether it is small, big, or big in size, whether it is a manufacturing company or trading entity or service company, they need cash to run their business. They also need cash for their future investment. Cash would also be needed for payments of dividends to their shareholders, as well as repayments of loan to the loan provider, to the bank, to the debenture holders. Right? Therefore, any entity is required to generate cash and utilizes cash continuously, especially in this area or in the situation where now we are facing this COVID-19 pandemic, where cash flow management is vital for the survival of a business entity to ensure it is still a going concern entity. Not just for manufacturing company, not just for trading entity or service company that cash is king. It is also the same for the case of banks and financial institutions. They are not an exception. Even if they deal with financial products, accept deposit from customer, and give loans day in and day out, they still need to generate the cash profit for their own entity. They themselves need to make investment in terms of maybe having new branches, having new setup, having online banking being set up, or etc. And therefore, statement of cash flow or the preparation of statement of cash flow is equally important for banking and financial institution as well. Right. Okay, that's the beginning of it. Let's see, what do we have here? Okay, before this, you were introduced to statement of financial position and statement of profit or loss in your earlier studies. However, that two statements do not show the sources of cash received and how the cash is used. Right? So therefore, statement of financial position, for example, is just a snapshot of entities' financial resources, which we call them asset, and also their obligation by way of liabilities, as well as a statement of financial position also give us some information regarding the equities of the company at a particular point of time. Statement of profit or loss, however, will only show some kind of financial performance or how profitable for the reporting period the company is, or maybe in certain situation how terrible is the losses that the company is now experiencing. Expenses, for example, they are recognized as they are incurred. Same goes for revenues. They are recognized in the financial statement, in the statement of profit or loss, as they are earned. And these two statements, which is statement of financial position and statement of profit or loss, they are based on the so-called accrual basis of accounting, where the transactions are recorded as they are happening or as they are incurred. Okay, so therefore, for that reason, it includes transactions that do not affect cash receipt and payment. So meaning that it is not just about having transaction which generate cash payment and cash receipt, but it is also including those transactions that do not bring in cash or do not utilize cash. So therefore, we need another statement to show some movement of cash, to show how good are we at generating cash and how good are we at utilizing our cash, because expenses are not equal to cash outflows. Same goes for revenues. Revenues are not equal to cash inflows. So let's look at what is statement of cash flow. Mfrs 107, which is the standards, or in international standards we have in IAS 7, requires all entities to prepare a statement of cash flows as integral component of financial statement. So basically cash flow is part of the financial statement for each reporting period. So it has to be prepared for each reporting period. Let's say the reporting period starts 1st of January 2019 and ends 31st of December 2019. So it has to be prepared for that reporting period, together with other financial statements like your statement of profit or loss and other comprehensive income, statement of changes in equity, your statement of financial position. However, the financial statements, by just having that statement of profit or loss or having the statement of financial position, they are incomplete if a statement of cash flows are not prepared. So to make your financial statement complete, a statement of cash flows are not an option. Statement of cash flows will include only inflows and outflows of cash and cash equivalent. So we have a new thing perhaps, which is cash equivalent. Cash is what is very familiar to most of us, but the term cash equivalent. So we would like to see that statement of cash flows only include cash and cash equivalent, either inflows or outflows. And therefore, statement of cash flow is based on cash basis of accounting. It will only take into consideration or report the transaction that is on cash basis. It will exclude transactions that do not affect cash receipts and payment. So if, let's say, your transaction has included those transactions that are non-cash, that will be excluded from the statement of cash flow. For example, statement of profit or loss and other comprehensive income. Statement of changes in equity. These are the two statements that are also prepared for the reporting period. Let's say the reporting period is starting from 31st of December 2000X2, this is the current year. It ends on 31st of December 2000X2. And normally on that date, the statement of financial position will be prepared, assuming if this is prepared once a year. And in the previous year, the same statement has been prepared, which is on 31st of December 2000X1. So these two statements are called comparative statement of financial position. One was prepared at the prior year or the immediate prior year, and another one is prepared during the current year. And as we knew, the statement of financial position is prepared at a point in time. However, for the statement of cash flow, it will be prepared for the reporting period. It can be prepared for yearly basis, which is for 1 year period, for monthly reporting period, or maybe quarterly reporting period. But in our case today, our focus is for the annual financial statement. So it is going to be prepared for 1 whole year. 1 whole year means whatever starting from 1st of January 2000x2, beginning of the current year, and the one at the end of the year that will end on 31st of December 2000x2. Next. What is statement of cash flows? So according to Mfrs 107, statement of cash flow prescribe the principle and guidance on the preparation and presentation of cash flows of an entities coming from three activities, which is operating activities, investing activities, and financing activities for a reporting period. It provides details about how the cash is generated by the company or by the reporting entity, meaning that what are the source of cash inflow, that is where we call cash is generated, how it is being used, what is the source of cash outflow, or how cash is being spent by an entity during a particular reporting period. However, as I said earlier, it excludes transactions that do not affect cash receipts and payment. It will focus only on transactions that affect cash receipts and payment. As I said earlier, how cash is being generated is cash inflows. How cash is being used is cash outflow. So there's a mistake here. So let me just make a little adjustment here because there's a typo. Okay, just make it. So here it should be outflow. It should be outflow of cash and cash equivalent. So how cash is used is called cash outflow. And at the end of the day, statement of cash flow or SOCF will reconcile the opening balances of these cash and cash equivalents with the closing balances of cash and cash equivalent. Opening balances mean 1st of January 2000x2 just now. And closing balances is the one that were as at 31st of December 2000x2, just like what we discussed. And we need to give reason for the changes that happen during the year. And these cash and cash equivalents will have to be later reconciled with the three activities that were mentioned here: the operating activities, investing activities, and financing activities. What are the objectives of cash flow statement? These are the objectives of cash flow statement: to generate cash and cash equivalent, to utilize that cash flows, looking at the timing and certainty of generation of cash flows, and also to provide information about the historical changes in cash and cash equivalent. So that is the requirement. And these are some example of how you generate cash and cash equivalent, because you may look profitable but you may not have enough cash to pay your debts or to pay your dividend. Yeah, it can also show some kind of trend regarding the years in which the company generate fair amount of cash and probability of generating it again. So it gives you some information about certainty and also some timing information about the capability of the company to generate cash. Next is, since it gives information about the historical changes, therefore for current and immediate prior years, the aim is to provide information about how cash has been generated during the year and how, for what purpose has it been utilized. So during the year, meaning that looking at what happened in the prior year, looking at what happened in the current year, we'll be able to have an idea of how cash has been generated and for what purpose has as the cash being utilized according to the 3 types of activities. These are the presentation of cash flow statement, where cash flow statement, as I said, will report cash flow, either inflow and outflows during a reporting period using 2 methods. You have option to select the method that is more desirable to the company, either the direct method or the indirect method. So under both method, you will have to present the operating activities, the investing activities, the financing activities, as well as the cash and cash equivalent. So there are generally 4 sections in the cash flow. Section 1 is on operating activities, Section 2 is on investing activities, Section 3 is on financing activities, and the last section is cash and cash equivalent. And what makes the difference between the 2 methods is the way the operating activities are being presented. So operating activities will go into detail what are operating activities, what are investing activities, and what are financing activities. But today, just to focus, what makes the difference between the 2 methods is the way the operating activities are being presented. So under the both direct and indirect method, the presentation for investing and financing activities are the same. What makes different is the presentation under operating activities, where under the direct method, the starting point is looking at the major gross cash receipts and gross cash payments. And then under the indirect method, the starting point to start off the cash flow is using the profit before tax, adjusting for non-cash transaction and non-operating items. And profit before tax will be the starting point to start off the cash flow under indirect method. So normally this will be given. We'll go into detail when we be doing that in our simple example, simple exercise, looking at the format into great detail. And entities are encouraged to follow the direct method. It's not a compulsory method, but they are encouraged to do so. But you would see that in reality, a lot of companies are using the indirect method. So we'll have to see why this happened. It is, at the end of the day, is a choice of the company that may have minimum effect in terms of the timing and the complexity in the preparation of cash flow. Next. So now we look at the first section of the cash flow, which is in the statement of cash flow regarding cash flow from operating activities. Cash flow from operating activities are from the principal revenue producing activities of the company and other activities which are not investing or financing. So the best thing to do is for us to look at what are financing activities, what are investing activities, whatever that are not investing or financing activities are going to be put under operating activities. So these are some examples of cash flow coming from operating activities, which are the cash inflow. Cash inflow is when you debit your bank account, right? You debit your bank account. And under operating activities, these are from the sale of goods and the rendering of services from sale of goods. Maybe the cash sales that you debited to the bank, or maybe the collection from the customer that you debited to the bank. From the royalties, fees, commission, and other revenues for an insurance entity, from premiums, refund from income tax, or maybe from contract held for dealing or trading purposes. But our focus will be on the first 2, A and B. The next one is example of cash flow or cash payments that comes from operating activities. These are, for example, cash payment to suppliers for goods and services that were offered by the suppliers in the ordinary course of business. Cash payments to and on behalf of employees, basically the salaries, right, that we pay to our employee. Or example of insurance entity, the one for premiums and claims, annuities, and other policy benefits. Cash payments for income tax unless it can be specifically identified within financing and investing activities. And also for contract held for dealing or trading purposes. But our focus will still be on the first two. Next, we'll be looking at cash flow from investing activities. Cash flow from investing activities are from the acquisition and disposal of long-term non-current asset. When we say about long-term non-current asset, that can be either non-current tangible or non-current intangible asset. And also investment. Investment here are investment which are of long-term investment, which are not included in cash and cash equivalent. Under cash and cash equivalent, investment will be included if the period is less than 90 days or 3 months. Example of cash inflows or cash receipt coming from investing activities: from the disposal or sale of property, plant, equipment, intangible asset, and other long-term asset like investment property and biological asset. From the sale of equity or debt instrument, this one is for joint ventures, company that has joint ventures. From the repayment of advance and loan made to other parties, from dividend and interest income received from investment in other companies, right? So you can also include here rental income coming from the let out of your building or your land. Basically, if that is the income coming from your investment property, the rental income received can also be included under investing activities. Example of cash flows coming from outflows coming from investing activities are cash that you spend to acquire property, plant and equipment, intangibles, and other long-term assets like investment property and biological assets. And these payments can also include those relating to the capitalization of development costs under Mfrs 138 or IAS 8 on intangible asset, where development costs that meet the capitalization criteria will be capitalized. Or these can also be payment relating to the self-constructed property, plant and equipment. And B is also the cash outflows to acquire equity or debt instrument of entities in joint ventures, other than payment for those instruments considered to be cash equivalent for those held for trading or trading purposes, dealing or trading purposes. So our focus will be mainly on this, looking at the acquisition of investment, acquisition of PPE, the acquisition of investment property, acquisition of intangible asset like patents, and acquisition of development costs or development costs that will capitalize. Cash flow from financing activities, the cash flow related to raising of funds or capital. So this is how we fund our company, maybe through issue of shares or sometimes through our source of finance, like through our liabilities. That one is how we raise, and as well as how we make payment or do redemption of that fund and or capital. Financing activities are activities that result in changes in the size and composition of the contributed equity, namely the issued share capital, or maybe the related reserve, and the borrowings. So anything that result in the changes that bring in cash or utilize cash related to share capital, reserve, and borrowings. Borrowings are non-current liabilities like loans, debentures, right, bonds of the entity. Example of cash inflow or cash receipts under financing activities. And these are also some example that will be shown of cash outflows or cash payments under financing activities. For example, cash proceed from issuing shares or other equity instrument, cash proceed from the right issue of ordinary shares, cash proceeds from issuing debentures, loans, notes, bond, mortgages, and other short-term or long-term borrowing. Next, cash outflow, or what are the cash payments that will be put under financing activities? Dividend paid to shareholders, although it is also possible to be put under operating activities. It can be put either here or under operating activities. Cash payments to owners to purchase own shares or on share buyback exercise. So let's say you decide to buy back your own shares from the open market for cancellation. So that cash payments to acquire the ordinary shares are part of financing activities. Cash payment to redeem the entity's preference shares and debentures. Cash repayments of amount borrowed, maybe from the bank or financial institution, and for the loans that you took, for the mortgages that you need to repay, right? And also for payments by lessee for reduction of the outstanding liability relating to lease. That is under financing activities. And these are some special discussion regarding interest and dividend, as I mentioned just now. Dividend paid can be put under financing activities, and those dividend and interest shall be disclosed separately, either dividend that are an expense or dividends that are an income, as well as interest expense and interest which is an income. For financial institution, interest paid is normally classified under operating activities. Same goes for the dividend and interest received. For the dividend paid for the financial institution, it will be put under financing activities for financial institution. Why? Because they are the cost of obtaining financial resources. Because the more you give dividends, the more the depositor or the investor will be investing in your company. So give you the source of funding, source of finance or capital. And therefore dividends are cost of obtaining that financial resources. In the case of other entities which are not banks or financial institutions, let's say manufacturing entity, let's say trading entity, or any other service entity which are not bank or financial institutions, the dividend paid can be classified as cash flow from financing activities. It can also be classified as cash flow from operating activities. Yeah, can be classified as cash flow from operating activities as well. Interest paid is the same case. You can classify under cash flow from financing activities, but for my example, you will notice that I put interest paid under operating activities. So that is an option that we can take. And we are going to adjust the interest paid when we calculate profit before taxation. And for my examples later, you will see that I put dividend paid under financing activities. For interest and dividend received, you can see that it can be included under operating activities, right? However, it is also common to see that interest income received and dividend received, which is investment income or income from investment. In interest and dividend income are income from investment. So the one that you actually receive in cash can be classified as cash flow from investing activities, which is a cash receipt, and because they are returned for the investment that we make. So these are just some special discussion on interest and dividend, both expense and income. For non-cash transaction, as I said earlier, the non-cash transaction will not be included in the cash flow. So investing and financing transactions that do not require the use of cash or cash equivalent will be excluded from the statement of cash flows. Because many investing and financing activities do not have direct impact on cash flows, although they do affect the capital asset structure of an entity. Let's say bonus issue, for example, it does not have direct impact on cash flow. However, it will affect the share capital structure of the company. These are some examples of non-cash transactions that were commonly found in cases relating to preparation of cash flow. Depreciation of asset, bonus issue, as I mentioned, asset acquired under lease, these are all non-cash transactions. Conversion of convertible debentures into equity shares, increase in the property, plant, and equipment due to surplus or deficit on revaluation, which we recognize as part of other comprehensive income, and then later shown as our revaluation reserve movement. The fair value gain or loss of an investment property that are measured using fair value model. The fair value gain or loss of biological asset under IAS 41 and Mfrs 141 that are measured at fair value less cost to sell. If these are non-cash transaction, if they are included in the preparation of a statement of profit or loss. So when you prepare the statement of cash flow, you will notice that these adjustment or these non-cash transaction will have to be adjusted. Amortization expense on intangible assets, impairment losses on non-current asset, impairment losses on intangible asset, impairment losses on PPE, or maybe impairment losses on the investment property that adopt the cost model. So such transaction shall be disclosed as well in the financial statement. It will be disclosed, but not in the cash flow. It might be disclosed in the statement of changes in equity, statement of profit or loss, and other comprehensive income, and statement of financial position, but shouldn't be disclosed in the statement of cash flow, so that we provide relevant information about these investing and financing activities. We'll proceed with our next video to discuss on the so-called pro forma format for our direct and indirect method in the preparation of cash flow. Have something for you to ponder. A dream does not become reality through magic. It takes sweat, determination, and hard work. So does cash flow. With that, I thank you for listening and watching. I'll see you when I will see you. I'll see you in the next video to prepare cash flow using direct method. And before that, we will discuss the presentation of cash flow under both direct method and indirect method. With that, I'll thank you for watching. Assalamualaikum warahmatullahi.